Welcome. In this third and final part of the video, I am analyzing the cash flow statement and the quarterly profit and loss account. So let's begin our analysis of the cash flow statement first. The cash flow statement is an important statement as it shows the actual cash the company has received or spent on its three main activities. That is the cash earned from operating activities, cash which has come or has been invested in the investing activity, and finally the cash which has come in or has been spent in the financing activity. Cash flow statement would show how the business has actually used its cash during the year. So it's a very important statement to look at. If the business has received more cash than what it has spent during the year, it will have a positive cash flow, and vice versa. Cash flow is different from the profit and loss account because it is only concerned with the cash transaction. Things like depreciation, credit sales, purchases, write-offs like bad debts, etc., they are not included in this cash flow statement analysis. So basically we will be only analyzing the cash inflows and outflows that has taken place during the year. So let's look at the cash coming in from operating activity, or if cash has gone into operating activity. The cash flow from operating activities, or CFO, it measures the amount of money the company has received in cash during the year from its normal business operations or activities. The cash coming from the business operations should be increasing over the years. Here we see that from March 15 to 17, the cash was coming in and it was increasing gradually, but in 18 and 19 the cash that was coming in only from the operating activities has dropped by almost half. Increasing cash again would indicate that the company is generating cash from its operations. So in the first 3 years it was generating, but after 18 and 19 the cash has suddenly dropped by 50% at least. The cash from operations should be positive. Here we see all of them are positive values, and a negative cash from operation would mean that the company has spent more than what it has managed to generate from the operations. So the cash from operations includes only cash inflows and outflows during the year, and that too only from the business activity or the operating activity that the business has conducted during the year. Now in this chart we will look at the cash which has come in or has gone into the investing activity, and this measures the amount of cash the company has put into investment activity like buying assets or investing in mutual funds, shares of other companies, etc. Usually the companies will have a negative cash from investment activity, which then indicates that there is a cash outflow in buying assets or investing excess cash in mutual funds, etc. So here we see that from 15 to 17, all the 3 years the company's investment activity has seen an inflows, that is company has been spending in its investing activity. This could be either for purchase of assets or doing normal investing activity, as I said earlier, like buying mutual funds, etc. But in the last 2 years of 18 and 19, the amount of money that is being invested has dropped to only 310 crores. That's a decrease from where it was going in the first 3 years. Next we'll look at how much cash has come in or has gone into the financing activity. This measures the amount of cash the company has received from financing activity or paid out through financing activity, and this will show negative, or generally it will show negative or outflows if the company is paying dividends or doing buyback, because it has to spend money for dividends and buybacks, or even if it's paying its interest on its borrowings, it will show a negative if it has spent a very high substantial amount in paying the interest, or even if it pays off the loans, etc. And it will show positive values or inflows if the company has raised money through borrowings or issued more shares. So if the company is issuing shares, then it will receive money, so that will show a positive value. Whereas if the company is paying dividend or paying interest, then it will show negative. Negative means the money has gone out of the business in the financing activity. So here in almost all of the years, the company's position has always been in the negative, and this is how it should be normally for most of the companies, which indicates that the company has been spending or paying off either dividend or bonus or whatever it may be. So that needs to be looked into by checking out the actual cash flow statement and looking out on the actual line items of what the company has spent in financing activity. In this chart, we are looking at the net cash flow, which means that we are trying to understand here is how much cash came in or went outside the business during the year from all the three activities combined. So net, how much cash came into the business or went out of the business. A positive cash flow or net cash flow would indicate it's a positive indicator, because it means that the company has spent less than what it earned from the operating activity. And a negative cash, net negative cash, would mean that either the company has received less cash from its operations or large cash has been invested in assets or investing activity, or it could also mean that the cash has went out to pay dividend or paying back the loans the company has taken. These are the overall net values after taking or after considering all the three activities that the business does. This chart is very important to look at and understand, because here we are comparing the profit before tax with the amount of cash the company has received through operations. This is a very important statement or a ratio that each investor should look at. Here we are trying to compare the profit before tax with the cash coming in through operating activities. The profits includes non-cash expenditure and non-operating income and expenditure. So it's very important to understand these two things. One is that the profit and loss account considers both the non-cash expenditure, where like depreciation, and also non-operating income and expenditure like exceptional gains or one-time sell-offs, or a sell-off of one part of the business where the company has received money, or write-offs where the company has made losses. So profit and loss account would include all of these, and that is why it is more prone to manipulation and large variations in its net profit figure. Whereas the cash flow from operations includes the cash expenditure and cash incomes only, and that too only from the operating activity. So this is a very important ratio to look at. The cash coming in through operations should be equal to or more than the profit before tax. Here in the last 3 years on average, the company's profits before tax was around 16,300 crores and the cash coming in was around 13,186 crores. These are the average values of the last 3 years. This 81% indicates that the company's cash coming in was 81% of the profit before tax. But what we want is that the cash coming in through operations should be equal to or more than the profit before tax. Here we see that the company's cash coming in is just 81% of the profit. Here we want the cash to be at least equal to 16,000 or more than 16,000. But when we look at the last 5 years also, we see it was somewhere around 87%, and the last 7 years average cash collection was around 86% of the profit before tax. So this is what the company's average have been over the past years, and this looks quite stable. But if you see, the profit before tax of the average has been falling consistently, and even the cash coming in through operations has been falling consistently. So this is a kind of a worrying sign. It would be a red flag if the company is not able to translate profits into cash. Here it is able to translate, around 81% is coming in by way of cash. Average PBT and both average cash, as I explained earlier, should be increasing over the years, whereas we see that it has been decreasing on an average basis. In this chart, we are trying to understand how much cash was used for investing activity out of the cash earned from operations. The company should not invest a very high percentage of cash earned through operations in investing activity unless it is in a growth stage or expanding its business. Up to 50% of the cash may be invested back into the business for purchasing assets or doing investing activity. We don't want a very high percentage of cash coming in from operations to be invested in the investing activity, because we also need a part of the cash for financing activity, financing requirements. So we see in the last 3 years the company has earned around 13,000 on average every year as cash from operations, whereas it is investing 7,600 in its investing activity. That's a 58% of the cash earned from operations. So around 58% of the cash which was earned from operations was invested in investing activity. Next, we are looking at the quarterly profit and loss account analysis. This analysis indicates how the business is performing in the last few quarters. It also helps us in understanding how the company is performing compared to its long-term performance of both the 5 and the 3 years. Our decision to invest in companies' shares should not be based on the quarterly performance, but rather its long-term figures of 5 and 3 years. The quarterly data should be tracked to understand how the company is performing and is it in line with our expectations. Any large variations in the quarterly figures should be immediately investigated, and we should take an action if we find something is not proper. So let's begin our quarterly profit and loss analysis by looking at the sales and the net profit figures. The sales and the net profit should show an upward trend over the quarters. We have the data up till September 2019. In September, the company's sales was around 8,100 crores and the profit coming in was around 1,064 crores. But in September 18, we see a net loss of 269 crores. So from 269 crores of net loss, the company has moved into profit, that is YOY, whereas from its previous quarter, that is June 19 to September 19, we have seen a fall of almost around 300 crores in net profit figure. The sales has also dipped quarter on quarter, and but from year ago period it has increased from 6,900 to 8,100 crores in terms of sales. Any large variations in both the sales and the profit figures should be investigated. We don't see a very large variations, but there is no trend as such in terms of both sales and net profit. So sales has grown by 17% YOY, whereas from its previous quarter it has fallen by almost 3%. We should investigate if there is a large variations in both the sales and the profit. We should see a positive growth in sales from its previous quarters. Anything about 10% of growth is considered positive. Whereas if we look at the profit growth YOY and quarter on quarter, we see that YOY it has in fact turned positive. Here it's showing negative because of the calculation, but from loss in September 2018 it has come into profit in September 2019. So we can ignore this value. Quarter on quarter it has dropped, the profit has fallen by almost 23%. This is correct because we see in the previous first chart where the profit had fallen slightly from by almost 300 crores from its previous quarter of September 2019. Any large variation again needs to be investigated. We should see a positive net profit growth from both its previous quarter and a year ago quarter. Here both although YOY it has come into positive, quarter on quarter it is still negative. Finally, let's look at the net profit margin. This should be about 10% or industry standard on average basis. As in the annual profit and loss account analysis, there too we wanted the P&L, there too we wanted the net profit margin to be about 10% on an annual basis. Same thing for quarterly analysis. In September 18, as we saw earlier, the company had made losses. That was a 3.9% loss on its total sales. This is still okay. Now in September 19, it has turned about 10% of NPM figure. Even in June and December 18, it had about 10% of NPM, which is a good value, except there was a dip in March 19 to 8.9%. So this concludes our analysis of this company. I recommend to you all that you watch the previous videos where I have analyzed both the annual P&L account and the balance sheet to understand it in much detail. Thanks for watching this video.